Well, let's all have some fun and let's read the minutes from the last FOMC meeting. This time they're a little bit on the boring side. This time they're a little bit on the boring side. There's a few interesting statements in here, but I've highlighted a few things, not as much as I normally do, but we'll just read some points here. We'll start with the staff economic outlook. And what stands out here is there is no talk about any kind of recession at all. The economic forecast prepared by the staff for the January meeting was slightly stronger than the December projection. So they have moved up. And they make, as I say, no reference to any recession or probability of recession. The lagged effects of early monetary policy actions through their continued contribution to tight financial and credit conditions were still expected to push output growth in 2024 and 2025 below the staff's estimate of potential growth. In 2026, output was expected to rise in line with potential. So they're basically forecasting 2 years of sub-potential growth. We certainly haven't seen that in the latter part of 2023. The retail sales for January kind of indicate that might be in the works, but the labor market doesn't. The projected path for the unemployment rate was revised down slightly, reflecting the upward revision to the level of output. Total and core PCE price inflation were both projected to step down in 2024 as demand and supply in product and labor markets moved into better alignment. By 2026, total and core PCE price inflation were expected to be close to 2%. I think that happens a lot faster. I think that happens by the end of 2024. I think they are underestimating the progress of technology and of productivity in getting unit costs lower. We've seen that in Q3 of 2023, Q4 of 2023. If you have productivity gains, you can get your, the level of disinflation they're looking at a much more rapid pace. I don't see 2026, or taking to 2026. I think by the end of the year, we'll be well below the 2%. The staff placed some weight on the possibility that further progress in reducing inflation could take longer than expected. It would have been nice if they would have given a point or two of why they think it would take longer than expected, other than just saying it's going to take longer. Let's move to the participants. This was the staff. Now we're going to the bigwigs around the table, the ones that vote. Participants observed that the unexpected strength in real GDP growth in the fourth quarter reflected stronger than expected net exports and inventory investment, which tend to be volatile and may carry little signal for future growth. Consumption was still strong, as I was highlighting them, saying, well, consumption was still strong, and of course, there's the next sentence. Still, consumption continued to grow at a solid pace. In addition to strong demand, many participants attributed the recent expansion in economic activity to favorable supply developments. Regarding the economic outlook, participants judged that the current stance in monetary policy was restrictive and would continue to put downward pressure on economic activity and inflation. I like the way they say that. It will continue to put downward pressure. It has not yet. So, if it had put downward pressure on economic activity, I think you can use the word continue. It will begin to put downward pressure on economic activity and continue to put downward pressure on inflation, I think would be a better way to write that sentence. In light of the policy restraint in place, along with more favorable inflation data amid ongoing improvements in supply conditions, participants viewed the risks to achieving the committee's employment and inflation goals as moving into better balance. Participants noted improvements in both headline and core inflation and discussed the underlying components of these series. This little part here starts to get interesting. Although total PCE inflation in December remained above the committee's 2% objective on a 12-month basis, on a 6-month basis, total PCE inflation was near 2% at an annual rate, and core PCE inflation was just below 2%. They don't talk about the 3-month annualized, which is below 2%. Participants judged that some of the recent improvements in inflation reflected idiosyncratic movements in a few series. And then they just stop. You say something like that, like a few sentences would be nice as well. What do you mean idiosyncratic movements in a few series? Which ones are you talking about? Judged that some of the recent improvement was idiosyncratic movement in a few series. That's a pretty big statement. I'd like a little bit of clarity on that, but no, you're not going to get anything. Many participants indicated that they expected core, non-housing services inflation. Just let's get that straight. Non-housing. So it's core services, but non-housing. Core non-housing services inflation to gradually decline further as the labor market continued to move in a better balance and wage growth moderated further. I don't know why they don't say anything about productivity gains continue, because that's a big deal. Right? You can pay people 10% more every year if you're getting 15% more output. That's deflationary. Don't know why they didn't add that in there. Various participants noted that housing services inflation was likely to fall further as the deceleration in rents on new leases continue to pass through to measures of such inflation. And in the last CPI report, we saw that was part of the problem. When we looked at where was the series pulling the month-over-month higher, it was in housing. Some participants pointed to reports from contacts that firms could not easily pass on price increases to consumers or were making less frequent price adjustments than they had in recent years. Moving to the household sector, a number of participants judged that consumption growth was likely to moderate this year as growth in labor income was expected to slow and pandemic-related excess savings were expected to diminish. Some participants noted signs that the finances of some households were increasingly coming under pressure. They pointed to increased usage of credit card revolving balances and buy now, pay later services, as well as increased delinquency rates for some types of consumer loans. Going to the top. Consistent with the reduction in labor market tightness, business contacts in several districts reported an easing in wage pressure or an increased ability to hire and retain workers. Participants mentioned several developments that had boosted labor supply last year, including higher labor force participation, immigration, and an improved job matching process. I'm not sure what that job matching process is. However, a few participants judged that further increases in labor supply may be limited, pointing, for instance, to the decline in labor force participation in December. While labor market conditions were generally seen as strong, several participants noted that recent job gains were concentrated in a few sectors, which in their view pointed to downside risks to the outlook for employment. Furthermore, several participants mentioned the risk. This I found really interesting here. Furthermore, several participants mentioned the risk that financial conditions were or could become less restrictive than appropriate, which could add undue momentum to aggregate demand and cause progress on inflation to stall. So this is related to capital market yields, a bull flattening of the curve, yields going lower, bond prices going higher, and potentially to equity markets hitting new highs as it has been doing all year long. I find it the use of the verbs conditions were, if we take that out, the or could become, were less restrictive than appropriate. The financial conditions were or could become less restrictive. So some were saying, they were, and some are saying they could become. Were is sort of a state that already exists. In the discussion of financial stability, participants observed that risks to the banking system had receded, notably since last spring, though they noted vulnerabilities at some banks that they assessed warranted monitoring. These participants noted potential risks for some banks associated with increased funding costs. Well, for some banks, all banks, increased funding costs. Significant reliance on uninsured deposits. Unrealized losses on assets resulting from the rise in longer-term interest rates or high CRE exposure. All participants judged it appropriate. I'm highlighting this because it is all. There's no dissenters here. All participants judge it appropriate to maintain the target range for the Fed funds rate at 5.25% to 5.5% at this meeting. All participants also judge it appropriate to continue the process of reducing the Federal Reserve securities holdings. Participants commented that maintaining the target range for the federal funds rate at this meeting would promote further progress toward the committee's goal and allow participants to gather additional information to evaluate this progress. In discussing the policy outlook, participants judged that the policy rate was likely at its peak for this tightening cycle. Participants generally noted that they did not expect it would be appropriate to reduce the target range for the federal funds rate until they had gained greater confidence that inflation was moving sustainably toward 2%. That would mean the January CPI, which we got in February, the February read on the January CPI is sort of working against that. That kicks the can down the road for rate cuts because it moved in the opposite direction, not in the sustained downward direction, unless we get revisions that revise that away, and when we get to March, February's read comes in much lower. And then you might have, potentially maybe before the end of Q2, a rate cut. Let's see what else we have. Some participants noted the risk that progress toward price stability could stall, particularly if aggregate demand strengthened or supply side healing slowed more than expected. Earlier, they talked about consumer demand probably dropping because wage growth was moderating, so further growth in consumption would moderate. And here they're talking about aggregate demand strengthening, the possibility of aggregate demand strengthening. I don't know that that is consistent with what their forecast was earlier. Or supply side healing slowed more than expected. I don't expect that. Participants highlighted the uncertainty associated with how long a restrictive monetary policy stance would need to be maintained. Most participants noted the risk of moving too quickly to ease the stance of policy and emphasized the importance of carefully assessing incoming data and judging whether inflation is moving down sustainably to 2%. A couple of participants, however, pointed to downside risks to the economy associated with maintaining an overly restrictive stance for too long. So we want to see where the weight of the committee is. Most participants noted moving too early would potentially cause a risk. And a couple noted that moving too late might cause a risk. Most versus a couple. Let's read that one sentence again with the most. Most participants noted the risks of moving too quickly. And that's why the bond market just did not like the meetings. It was that one. That's pushing rate cuts down the road. Participants observed that the continuing process of reducing the size of the Federal Reserve's balance sheet was an important part of the committee's overall approach to achieving its macroeconomic objectives, and that balance sheet runoff had so far proceeded smoothly. And this is the part I'm most interested in when they get to the reverse repo, in light of ongoing reductions in usage of the overnight reverse repo facility. Many participants suggested it would be appropriate to begin in-depth discussions of balance sheet issues at the committee's next meeting to guide an eventual decision to slow the pace of runoff. Some participants remarked that, given the uncertainty surrounding estimates of the ample level of reserves, I've said in previous videos, I think it's around 2.5 trillion. But given uncertainty surrounding the estimate of ample level of reserves, slowing the pace of runoff could help smooth the transition to that level of reserves, or could allow the committee to continue balance sheet runoff for longer. In addition, a few participants noted that the process of balance sheet runoff could continue for some time even after the committee begins to reduce the target range for the federal funds rate. So our next meeting, we will get more clarity on what they think, or some kind of estimate of where they think ample reserves are. I'm betting it's around 2.5, at least, based on where it was last time in 2019 when there was an issue. I think they don't want to get to those issues again. I think they'll probably think 2.5 trillion makes sense, which means given reserves at 3.5 trillion and reverse repos sitting just under 500 billion, they got about 1.5 trillion. At 95 billion runoff per month, you can do the math of 15 months basically. If you round it up to 100 and you got 1.5 trillion, you got roughly 15 months. I don't think they're going to go 15 months and just stop it. They would begin tapering it, so this will begin the conversation of when do we begin to reduce the amount of runoff. We're almost done here. So effective February 1st, 2024, FOMC committee directs the desk to conduct standing overnight repurchase. These are repos. Repos are done at 5.5. Here's the reverse repo. Reverse repo is done at 5.3. So they are bringing in money from the reverse repo at 5.3. And if they do repos, they're pushing money out at 5.5, making the spread. The thing is they have zero repos. If you look at their balance sheet from week to week, they got nothing going on in repos, only the reverse repo. And that gets us to the end of the Fed minutes. So the big takeaways here are there is, at the next meeting, there will be a robust conversation about the balance sheet. And we are left with a interest rate that's going to stay where it is, with a concern about cutting too early.